This show is intended for general purposes only, as individual situations may vary. Statements made should not be relied upon as recommendations or solicitation. When discussed, past performance is no guarantee or indication of future results. Nelson Financial Planning offers securities through Nelson Ivest Brokerage Services, member FINRA, and SIPC.
Good Sunday morning. This is Bud Hettinger. Next on News Radio 93.1 WFLA, the longest-running radio show in Central Florida, Dollars and Cents, with my good friend Joel Garris from Nelson Financial Planning. You can call him at the office this week at 407-629-6477 to schedule your free consultation to discuss your retirement plans, or you can talk to him right now at 407-916-5400.
Well, good morning, ladies and gentlemen. Welcome to the program Dollars and Cents. This is Joel Garris of Nelson Financial Planning. You're listening to News Radio 93.1 WFLA. On the program, as we do each and every Sunday morning, now over approaching 35 years that we've been on the air. Started all those many years ago by my now late father-in-law, Jack Nelson. The tradition continues with yours truly, Joel Garris. We've got much to talk about this week. We have to start, of course, with some commentary on China, which we'll do that in a little bit. Also want to share with you the latest study out of Yale, which, if this wasn't true before, certainly proves our theory and pretty much the theory that the entire media operates on, that bad news has a greater psychological effect on our minds than good. And we react very differently to bad news than we do to good. So we'll talk about that and how it relates to being an investor. Also have the latest numbers out of Social Security. Certainly a few things to talk about there, that's for sure. So, and then busy week ahead for me on a personal basis. We've got the oldest Nelson graduating from Boone High School on Tuesday. So that'll be a little different. A lot of family in town, had a little party, graduation party last night. And my dad's in town, and Aunt Janet's in town, and my goodness, it's a full house. I left the house this morning, and woke up this morning, realized that with all these people in the house, we didn't have any coffee. So we went and did a coffee run, and then ran up here to the studios in Maitland. And yes, graduation. I'm sure that will be an emotional day, right? If you've gone through that, I'm sure you can remember when your son or daughter graduated from high school, and so we've got some anticipation looking ahead to that. So it should be a good day. So, and then we'll deal with the fact that he's leaving and exiting the house, or mom. I always say mom deals with it more, but I certainly will as well. And it'll be a different dynamic around the house come fall. So, but anyway, that's the digression. Hopefully the only digression we'll have on the program, although we can't guarantee that. We may digress again, but let's get back on topic and talk a little bit about what dominated the headlines this past week. It's an oldie but a goodie, or maybe an oldie but not a goodie, and that was the conversation with China and the trade dispute that has been ongoing for a couple of years now, and we saw it once again come to the front and center of the headlines, and that obviously had a negative impact on the market. Although by the end of the week, market had recovered a chunk of that negative reaction from earlier in the week. But it was one of those things that I think kind of came a little bit out of the blue, where the story went from, well, everything seems to be progressing along, and the Chinese negotiators have agreed to some things, and then all of a sudden that kind of flipped, if you will, and so that news certainly had a pretty negative effect on the markets. Our view on that has not really changed. We certainly expect that it's going to continue to kind of pop up and certainly dominate the headlines until such time as there actually is an agreement. But when you stop and think about this relationship, and it really is a symbiotic relationship that the United States has with China. We, as consumers, need their stuff, and they, just like any economy that's trying to shift how its economic growth happens, they need us to be making that stuff in China. So there really is a much greater relationship between the U.S. and China than I think we really give credit for. I think we often have a negative connotation in terms of the conversation about debt. I mean, we often hear people talk about, oh, well, China owns us because they're the largest owner of United States treasuries, and that is true, but you really do have to dig a little bit deeper into that statistic. The reality is that foreigners own less than a third of all U.S. treasuries. There's a huge chunk that's owned by different government programs like Social Security, Medicare. There's also a huge chunk that's owned right here at home between pensions and mutual funds and the like. But of that third, certainly China is the largest. Overall, the number is right around about 7.5% of the total outstanding debt. So before you buy this conversation of China owning us, just remember that number. It's really only about 7.5% in terms of the total debt. This symbiotic relationship that exists on the economic side of things, I think, is one that we might often forget. Both of us are sort of mutually dependent upon each other, and right now, at least economically, I would say that the balance of economic strength is more in the U.S. side of things. Hard to ignore the latest GDP numbers that came out for the first quarter, an expected growth in the first quarter of this year of about 3.2% on the economy. That's a pretty strong number. Puts us in a relative bargaining strength, if you will, to the folks over in China, which are having certainly not issues with their economy, but it is not growing as fast. So you've got a relative advantage on that to the extent that you're trying to kind of get the other person to do something. We are negotiating from a little bit of a position of strength. But the bottom line is that because of that symbiotic relationship, we need them, they need us, and it is what it is. And so at the end of the day, there will be some kind of agreement. It certainly is in everybody's best interest to get some form of an agreement and get down to business. And I think that's the important thing to think about as we continue to go through and continue to have these headlines dominate the mainstream media. There could certainly be some effects on tariffs in terms of the availability or accessibility of things like of certain goods, particularly like toys. Most toys are made over in China. The only exception to that is Lego brand. So if this stuff continues, you may wind up having all of your gifts for kids and things like that be more Lego based than anything, because you might not be able to find as much on the shelves at a Walmart or a Target. But the majority of China's economy has now shifted to be more personal consumption. For many, many years, it was all about government spending, and so they've tried to shift that balance to effectively look more like our economy. When you look at our economy, we're about 70% based upon consumer spending, and about 15% on government spending, and the other 15% is corporate spending. In China, for many years, it was government spending that was the majority of that, and that has started to shift to be more on the personal spending side of things. So again, as their economy starts to look more and more like our economy in terms of what the components are that make it up, there's certainly a reason for everybody to kind of work together. And the presence of large corporations as well, companies like Alibaba, companies like Tencent that are Chinese companies, they are starting to be worldwide multinational companies. And so there's also an incentive for them to protect their intellectual property rights as well. And to a large extent, that's also a piece of this conversation is this protection of intellectual property. And they're starting to get to the point where that's going to become a bigger issue for them as well as these Chinese companies are ultimately developing their own intellectual property. So at the end of the day, it certainly is a story that will dominate the headlines until such time as there is some form of an agreement. But I think at the end of the day, that it is incumbent upon both countries to come to that agreement. In terms of what you can do in the interim, in terms of your portfolio, we will cover that and some things to certainly kind of look at. So we'll give you some tips or some things to ponder when we get back here after these messages here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning, News Radio 93.1 WFLA.
This is Bud Hedinger. You can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Welcome back to the program, ladies and gentlemen. This week on the program, we are talking about the headlines this past week. Once again, the simmering up to the front page of the China-U.S. trade negotiations, offering some perspective on it at the end of the deal. Certainly makes sense for both countries to come to a deal, and so we think ultimately there will be that. There may, however, be bouts of volatility like we saw this past week, but the numbers are what the numbers are. When you think about the amount of trade that happens between the two countries, it's certainly a lot, but there's some other things that you have to kind of realize, and we gave some perspective on that in the prior segment. I wanted to follow up in this segment with giving you actually some hard data. So one of the myths, if you will, is that China owns us, and the reality is that relative to all of the treasuries outstanding, it's actually relatively small. We mentioned around 7%, 7.5%. To put real dollars to it, China holds about $1.1 trillion in U.S. treasuries. That U.S. Treasury market, however, is a $22 trillion market. That's it's a pretty big market relative to. So might a 5 or 6% holder of the market be able to shift prices a little bit? Yeah, sure, if they decide to dump everything. But 5% in control of a market is not really the kinds of numbers that you need to ultimately shift that market over long term. And the reality is that where's that money going to go? Is it going to go to the German bund? Is it going to go to the Japanese yen? Check out their interest rates. They're zero. They're not going to do that. So put that one out of your mind, because the Chinese aren't in the business of selling stuff to reinvest it in stuff that's not going to generate even close to the same level of return that they're currently getting on U.S. Treasuries. I mean, they're not stupid. They're not going to sell a bunch of U.S. Treasuries, because where are they going to put the money? Because everybody else is yielding a much lower rate on their Treasuries. So don't get a whole lot of stock in that one. You also have to remember that in terms of interest rates are relatively low. and so consequently, that is certainly a something to consider when we think about the numbers going forward. We mentioned a little bit about the toys and stuff like that. Certainly, China did just report its weakest quarterly economic growth rate because of these conversations that involve trade. And again, that is the comment of how we are in a position of relative strength to the Chinese, at least in terms of the current negotiating context. And the last statistic that we will give you before giving you some thoughts on how to look at your personal portfolio, 21 trillion U.S. economy. Even if the full 500 billion in Chinese exports that would be at risk, if you look at that as a percentage basis, it works out to be just 2.4% of the U.S. GDP. So be careful about kind of these numbers and some of the stories that get fanned by the media, because when you look at the hard data, it in fact is quite different. Now, in terms of your portfolio, there are very specific things that you need to be considering. But before we get to that, we're going to slide to the phones because, Bob, you got a comment on China. Welcome to the program.
Hi. It's in the news that there's an ex-State Department official over there, went over to China and told them, don't make a deal with Trump. He'll be gone in a year and a half, and then you won't have to worry about this. That's treason to me. At least a violation of the Logan Act.
There is some speculation, and that's a fair point, Bob. There is some speculation that the Chinese have kind of have that thought in their head anyway, and hopefully it didn't come from a State Department official.
Her name is Susan Thornton.
Pardon?
Her name is Susan Thornton.
Oh, really? Okay, all right. They've got a specific name even on what that source. Well, everybody knows the elections are next November, but that would be a sad statement on our State Department, Bob.
It's sad to be sure and what they call the deep state. And I tell you, Joel, we have them 6-1. I mean, they're going to put tariffs on $60 billion of ours. We're going to put tariffs on $300 billion of theirs. And then the media is telling us that they're going to take a .22 caliber bolt-action rifle and kill one of our tanks, to put it in an allegory. This is crazy. We can't lose if we support our president. It's a war. We have to support our president.
Well, that's a fair comment, Bob. That's a fair comment indeed, especially during times like this. That is for sure. But I think the media is fanning this story of trying to impress upon everybody that the situation is more dire than it really is. I mean, to your point, you can look at the economic data and come to a very different conclusion of who is in the position of relative bargaining strength in terms of this conversation. And certainly there is that talk of, are they waiting until the election? And that might very well be true. They know that the election is in November. Hopefully someone from the State Department isn't telling them that as well. I think it's also incumbently clear that I wouldn't count Trump out in the next election. He did win one that he wasn't supposed to, and he certainly has a pretty strong economy that is, assuming it continues to carry forward over the next 12 or 18 months, going to be hard for anybody to defeat any sitting president, especially when the economic conditions are as good as they are now. I think that also, Bob, is why he's pushing the tariffs now. He's gone to the 25% to make sure that you don't get this delay game from the Chinese. So regardless of what some turkey in the State Department may or may not be telling them, at the end of the day, going to the 25% number really does help to force their hand to get to the table to have a conversation. So I think that's, to the extent you want to kind of get an agreement, certainly a good technique to be able to do that. And with that in mind, some comments on what you should be doing in terms of your portfolio. the best thing to do is to look at the percentage that is in large companies. Because when you think about large companies, think about large multinational companies, the companies like a Microsoft or a Disney or an Amazon. They make a tremendous amount of their revenue outside this country. So those types of companies that are large and big in nature I don't want to say that they're insulated from this kind of stuff, but at the end of the day, there is a certain level of insulation when you are doing business all over the world. As a large multinational company, you're ultimately navigating the rules of the road across multiple jurisdictions. And I think those types of companies are so important to own in an investment portfolio. So if you really are concerned about this China thing, I would take a look at the percentage of your portfolio that is invested in large companies, particularly those large multinational companies, because those types of companies are going to be able to kind of navigate the entire globe and not be so dependent upon what's going on purely in the U.S. or what's going on purely in China, which is another reason why we don't recommend sector funds or geographic sector funds like a China fund or something like that, simply because we think that there is too much volatility, too much risk for the return that you get by owning something that specific. So certainly some things to think about as it relates to these headlines about China and what you should be doing as an investor. Take a look at your own investment portfolio and really look at, okay, how much is of my portfolio is these large multinational companies that are navigating the entire globe and doing business all over the world. And those folks are generally going to be positioned to be able to adjust to disruptions in supply chains or what that could occur if trade tensions get more heightened than they are. So some things to be thinking about there. Also, I would not be owning a China-specific fund. I just wouldn't be owning that anyway because I'm just not a fan of limiting the investment choice in a sector-oriented fund. And I would say that that's probably generally true, not just of geographic sector funds, but also of industry sector funds. Just not generally a fan of them. Like to be a little bit more broad base with some flexibility to go where the opportunities are rather than be pigeonholed based upon the specific sector or geographic region that a particular fund has to stay in. So those are some thoughts on China and trade. And Bob, we certainly appreciate your thoughts as well. We'll slide to a break. We get back from the break, we're going to tell you the latest out of Yale that confirms one of the things we've been saying for decades on this program. Just one more study in the string of studies that has to do with investor psychology. So we'll cover that when we get back here on Dollars and Cents. This is Joel Garris, Nelson Financial Planning, here on News Radio 93.1 WFLA.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Welcome back to the program, ladies and gentlemen. This is Joel Garris of Nelson Financial Planning. For many, many years, we have been talking about the effect that the media has on people's perception of the market, the tendency, if you will, of the media to focus on the negative rather than the positive, and how much that messes with your mind, basically. Because at the end of the day, you always think that things are much, much worse than they actually are. I'm always amazed, even now, where when we sit with folks that we haven't seen for 6 months, they still think that their accounts are down dramatically as a result of what happened in November, December. which sort of completely ignores the fact that the markets have fully recovered from those declines and continue to proceed on to even higher levels. The reality is that most people still remember the negative event rather than recognizing what has been going on positively. And there's many studies on that in terms of behavior, and recency theory says that you only remember the events that are more recent, or you remember the events that are more negative. Well, we got one more study among all of those studies that just confirms that stuff that we say or have been saying for the past 3 decades. This comes to us, though, from Yale University, so you know it's got to be pretty high and mighty if it comes from Yale. A guy by the name of Robert Shiller, you may be somewhat familiar with him. He did share the Nobel Prize in Economics back in 2013, so obviously a pretty smart dude. And so at Yale, they have the International Center for Finance. Boy, that's impressive. Well, again, it's at Yale. And so they compile a stock market confidence index, which shows that investors are more likely to believe a market crash on the scale of 1929 or 1987 or 2008 is imminent in the coming 6 months if a recent sharp drop in stock prices was prominently covered in the media. I certainly hope that none of your tax dollars went to support the study at Yale, because pretty sure we knew that one already. But there it is. Fresh from Yale, I'll read it again. Investors are more likely to believe a market crash on the scale of 1929, 1987, or 2008 is imminent in the coming 6 months if a recent sharp drop in stock prices was prominently covered in the media. Conclusion of the study goes on. The sharper the recent fall, and the more prominent the news coverage, the more investors will tend to worry that a crash is coming. Well, no. Now, we didn't go to Yale, okay? We don't have a fancy Nobel Prize, but this is what we've been saying for many, many years on the program. Psychology is a large part of investing. And to invest well means that you have to fight your basic psychological characteristics. Because the human mind is a complex little item that we all have. And it causes negative events to get seared into our memories much more deeply than positive. Basically gets into your head and messes around with you. I don't necessarily need Yale to tell me that, but there you go. Now Yale has told you and me that same thing. Makes sense. Again, certainly hope your tax dollars didn't go to support that study, because I could have told them that conclusion and been saying that for many, many years. But hey, there you go. That's the latest and greatest out of the good folks at Yale. Speaking of the latest and greatest, we got the latest and greatest out of the folks at Social Security. Final tally of the numbers, if you will, for 2008. And the Social Security Trust Fund broke a record that had gone on for 34 years, all the way back to 1984 through 2017, that, in fact, the Social Security Trust Fund paid out more than what it took in. $853 billion was the payout in the year 2018. $831 billion was the pay-in. So that deficit in the year 2018 broke a streak of 34 consecutive years where there was income to Social Security, that meaning we are paying in taxes to Social Security, and those taxes paid in were more than what the benefits were that were paid out. So much for that streak. Back to the drawing board. The reality is that in the late 70s and early 80s, you saw that situation occur for a number of years. I think it was 7, might have been 8 during that period of time where that same situation existed, where Social Security was paying out more than what it was bringing in. Obviously, that puts Social Security on a very tenuous path of longevity in terms of being able to pay out benefits. And so what happened is that there was some changes. For example, an increase in retirement age from 65 to 67, and some other changes as well that effectively righted the ship, interestingly, for that long of a period of time. And that was the last year where there was really significant changes to Social Security in terms of the benefits that it pays out. So we shall see if maybe the statistics from 2018 caused the folks in Washington to begin to move forward and hopefully do something sooner rather than later to adjust the numbers on Social Security, particularly with it running in the red for last year, 2018, first year in 34 years where that has happened. The reality is that why that has happened, well, from 1950 to 2018, average age, life expectancy of a 65-year-old male has increased from 12 years to 18 years. So that's a 50% increase. Stop and think about that for just a second. A 50% increase in the average life expectancy over that period of time. If life expectancy has increased by 50%, well, obviously that translates to a much higher level of withdrawals on Social Security over time. So a lot of the fixes and a lot of the solutions, particularly the ones that happened in the early 80s, have to be looked at and observed again. Things like increasing the age, things like changing the age of eligibility. Certainly, I think Social Security as a program will continue to be around. It just has to change some of those fundamental things that it changed back 30 plus years ago to get it on a better track like it was on for the subsequent 34 years. So to be determined, I wonder how many years, because I think back in the early 80s, the Social Security program had to be in the red for a number of years, and it was in the red for a number of years before the folks in Washington actually got around to dealing with it. I wonder how many years it's going to take this time for them to get around to deal with it. Hopefully not many, because the sooner you fix something, the easier the fix is, right? Anyway, some thoughts and comments on Social Security and the latest numbers out. We'll slide to the break. We get back from the break. We will continue the conversation here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning, News Radio 93.1 WFLA.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Hey, welcome to the program, ladies and gentlemen. Dollars and Cents here on News Radio 93.1 WFLA. Also simulcasting over there on the AM dial. Can't forget about our friends over there. After all, that's where this program started way back 30-odd years ago, was over on the AM dial. Now there's this move to go to the FM dial, but fortunately we're still simulcasting, or the station is still simulcasting on both the FM and the AM dial. So hello to our folks on 540 AM. I'm not sure why we always have to say just the 93.1, but we'll say hello to the folks over on the AM dial as well. The old traditionalists, if you will. We like to have them listening into the program as well. On this segment of the program, I thought I would chat a little bit about Roth 401ks, and often those are an ever-increasing option that you have at your employer. So I wanted to kind of chat a little bit with you about that. If you look at the numbers over the course of the past dozen years or so, 401ks became eligible in the year 2006, in fact, to be able to offer an option where instead of the traditional pre-tax 401k plan, that you could also do the Roth. And the difference, again, is that if I do the pre-tax, I save money today on my taxes, which is a big deal, and we're big fans of that. That's why generally, more often than not, we advocate doing things on a pre-tax basis, whether that be an IRA instead of a Roth or a traditional 401k instead of a Roth 401k. Big fans of saving money today on the taxes because effectively that means I have more money, right? Because if I get a tax savings, then I effectively have more money, which means, hopefully, that you're able to save even more. And what we know is this: the more I save, the more I'll have for later on in retirement. But the difference, of course, pre-tax contributions save money on the taxes now. When you take it out, when you spend it in retirement, then you do have to pay taxes on it. The Roth, on the other hand, is after-tax contribution. So you don't save any money on your taxes now, but when you take it out, you don't have to pay taxes on that amount. And so since that Roth was introduced, and the Roth IRA was introduced many, many years ago, it was expanded, or that option was expanded to be available in 401ks about a dozen years or so ago. And since that time, you've actually seen where, not many 401ks were offering it, to a pretty consistent and steady growth over the course of the past dozen years, where now about 70% of all 401k retirement plans offer a Roth option. And then obviously over the next few years, we expect that to continue to build. So basically, if your 401k does not offer a Roth option, it probably will in the future, because the vast majority do now, and certainly that has been the ongoing trend for a dozen years. Interestingly, the percentage of workers who contribute to a Roth 401k has been relatively stable over that period of time, and not really as big of a difference versus the amount of the availability of that Roth 401k. So it's important to kind of, as you think about anything as it relates to your 401k, you certainly want to be doing the match. You certainly want to be aware of the fact that it's not an either or, it's not a mutually exclusive decision. So you can, in fact, put some in on a pre-tax basis. You can, in fact, put some in on an after-tax basis. So it's important to kind of think about where you are in terms of your tax return. So if you're in a high-income tax bracket, at the end of the day, you will need to consider doing it on a pre-tax basis in order to help with your taxes and help save money. If you're in a lower income tax bracket, and I'll use my soon-to-be graduating son Nelson on that. I think I mentioned a couple of weeks ago where he is now gainfully part of the workforce, so that's good. And we want him to be part of the workforce for a good long time, because he's got to start paying into the Social Security system so that us older folks will benefit from that. He did get his first paycheck deposited into his bank account, and in a way, I'm a little disappointed that it just went in as a deposit, and he didn't get to see sort of the gross amounts, because that really would help to drive the message home a little bit. And it just happened the other day, so I want to sit down and explain it a little bit to him, the difference between gross pay versus net pay, because just looking at the net deposit, he's like, oh, I got $206 deposited into my paycheck working at the car wash, and so that's great and that's fine, but just know that you got to kind of pay the taxes on that. Anyway, he's working at a car wash. His income is not that high, although he does get some pretty good tips, so that's good. And those are supposed to be reported, so that we'll leave it at that. Anyway, he's in a low tax bracket. So for him, what we'll do this year is we'll fund a Roth. Now, obviously, the car wash doesn't have a 401k or anything like that. It's a small business, but he does have the ability to do to fund either or not. Now that he has earned income, and remember, in order to fund any type of retirement account, you've got to have earned income. So in his case, low tax bracket, we'll look to do the Roth for his earnings that he has made, and so that becomes very powerful over the course of the next. For him, he's 18, so he's got to work definitely 50 more. And so that will have a pretty powerful compounding effect over the course of the next 50 years. But that becomes really a decision that you need to be thinking about as it relates to your 401k. Before, there really wasn't much of a decision because the only option was pre-tax. Now you've got the option between your traditional pre-tax approach or the Roth approach. Really look at sort of where you are on the tax bracket, what your tax return looks like, and whether it's going to make more sense to do it pre-tax to get that tax savings, or if you're in a lower income tax bracket, do the Roth. Or what you could also do is do a combination of both. Many people sort of like to do a combination of both. I'm going to get some tax savings, and I'm going to do some on an after-tax basis. That is an option. Know that you don't have to pick one and only do one. Generally, employer 401ks will allow you to sort of split it up between the two. Now, the total amount of those contributions has to stay below the aggregate number, which is $19,000 if you're under age 50 or $25,000 if you're over age 50. So, but as long as the combination, as long as you can do 19 in the pre-tax, 19 in the Roth, the total of contributions to both sides of the equation have got to stay below that 19,000 number. But you can also do some both. So that's often an approach, an idea that folks like to do to sort of cover both bases, and that's certainly a good idea. So something to kind of think about as it relates to your 401k at work. If you're the higher the tax bracket, stay more on the pre-tax side of things. If you want to kind of divide it up, so you've got some portion that's also on an after-tax, that's not a bad idea either. Between the two, I would certainly weight it much more heavily on the pre-tax side of things, particularly if your income is high. So some thoughts there on the latest in the 401k marketplace. Certainly more and more employers are offering the Roth as an option. We would expect that trend to continue to the point where it gets probably pretty close to 100%. 70% now of 401ks out there offer the Roth. Would expect that number to continue to increase as it has over the past decade or so. So certainly there's some things to think about as it relates to your company plan. Most importantly, you better be contributing at least to the match. To the extent that they match, you better be at least contributing to that money, because if you're not, you're leaving money on the table that is rightfully yours. So make sure that you are at least doing that. Well, we are about out of time, so we were going to wrap it up and get it on out of here. Enjoy the rest of the Sunday. Looks like a beautiful day out there in Central Florida, so enjoy it, and we will be back next week. Hard to believe next week's Memorial Day weekend, isn't it? Here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning on News Radio 93.1 WFLA. Fees, commissions, expenses, investment costs come in all shapes and sizes. Do you know how much your investments are really costing you? At Nelson Financial Planning, we believe that costs should be a major consideration in your financial plan. After all, the lower your costs are, the more you get to keep for yourself. This is Joel Garris, and I invite you to get educated about your investment costs. Visit nelsonfinancialplanning.com or call us today at 407-629-6477 to set up a personal conversation to review your investment costs. That's nelsonfinancialplanning.com or 407-629-6477 to set up that conversation.
A-plus Better Business Bureau accredited. Nelson Financial Planning offers securities through Nelson Ivest Brokerage Services. Member SIPC and FINRA. Listen to Joel Garris on Dollars and Cents every Sunday at 9 a.m. on News Radio 93.1 WFLA. This show is intended for general purposes only, as individual situations may vary. Statements made should not be relied upon as recommendations or solicitation. When discussed, past performance is no guarantee or indication of future results. Nelson Financial Planning offers securities through Nelson Ivest Brokerage Services, member FINRA, and SIPC.